Hello everyone, my name is Farhan. Today here we have a question for depreciation. I'll walk you through the question step by step. You can see the question on the left hand side of the screen, and on the right hand side you'll see all the workings which I'll explain. So with that being said, let's begin. Alright, so let's start with the question. The following balances were in the books of Christina, a retailer at 1 April 2016. So you can see that we are given the original cost of the machinery, which is $20,000, and the accumulated depreciation of machinery, which is $6,820. Both of these balances are at 1 April 2016. On 1 December 2016, our machinery purchased on 1 July 2014 for $12,000 was sold. So based on this first line, we understand that we have disposed a machine which had an original cost of $12,000, and the day we purchased this machine was on 1 July 2014. A check of £10,000 was deposited into the business bank account. So this is the amount we received by selling the machine, which is $10,000, also known as the disposal proceeds. On the same day, she bought one new machine for $13,500 from All Star Machines Limited on credit. So the last line here refers to a new purchase of a new machine, and that's for $13,500. Moving on to the next paragraph. It is Christina's policy to depreciate machinery at 20% per annum using the reducing balance method. A full year's depreciation is charged in the year of purchase, but no depreciation is charged in the year of sale. The accounting year of Christina ends on 31 March every year. So the first question is to calculate the profit or loss on disposal of the non-current asset. All right, so let's move to the workings, which you will see on the right hand side of your screen. Now we understand that we are working with a business where the financial year always starts on 1 April and the financial year ends on 31 March. All right, so if the financial year starts on 1 April in 2016, then it would end on 31 March in 2017. Now we understand, based on the first paragraph, that we have got rid of an old machine, and the original cost of that machine which we sold was $12,000. All right, now this machine was purchased on 1 July 2014, which is mentioned in the first paragraph. As you can see, I'm just underlining, and we know the company's policy is to apply a full depreciation in the year of purchase, right? Okay, now the first year of usage for this machine that we had sold is from 1 July 2014 all the way until 31 March 2015. And based on the company policy, we're applying a full depreciation in the first year. Although it's not 12 months that we had used this machine in the first year, we are still doing a full depreciation just because the company wants it to be done. So the depreciation in the first year of usage, when you're using the reducing balance method, is always calculated by multiplying the given percentage with the cost. The percentage is given to us as 20, and the cost, as we know, is $12,000. So on that basis, the depreciation in year one is $2,400. Now always remember to calculate the net book value at the end of the year, every time you're using the reducing balance method. Now the net book value at 31 March 2015, which is the end of the first year, is calculated as the difference between the cost and the accumulated depreciation, or the total depreciation at this point in time, which is 31 March 2015. So the original cost, as we understand, is $12,000, and the total depreciation is $2,400, because in the first year of usage, the depreciation that we have so far is $2,400. So altogether, the net book value at the end of 31 March 2015 is $9,600. All right? Okay. Now moving on to the second year of usage, that would be from 1 April 2015 until the end of 31 March 2016. All right. And you see, just before we had calculated the net book value. And the main reason for calculating that under the reducing balance method is when you move to year two, we find the depreciation by multiplying the given percentage with the net book value. So the depreciation in year two is calculated by multiplying the percentage with the net book value, which is 20% multiplied with 9,600, the net book value that we had at the end of the first year of usage. And that gives us a depreciation in year two of $1,920. Then you want to find the net book value at the end of year two, which is at 31 March 2016. And this time we find the net book value by taking the previous net book value of 9,600, which we had got on 31 March 2015, and subtract an additional depreciation of 1,920, which we had derived for the second year, right? On that basis, the net book value is $7,680 at 31 March 2016. All right, so let's move to year three. So year three for this particular asset is from 1 April 2016 until 30 November 2016. If you remember, we had sold this machine on 1 December 2016, which means the last day of usage would be on 30 November 2016. Make sense? All right. And we understand, based on the company's policy, that no depreciation is charged in the year of sale. So therefore, there's nothing to calculate in terms of depreciation in the third year, because that's the year we had sold this machine. Now we understand that we sold this machine for $10,000, which is known as the disposal proceeds, or which is also what you can simply say the cash or the money that we had received in our bank account, which is $10,000. All right. Now, have we made a profit or loss on disposal? Have we made a profit or loss on selling this non-current asset? All right. So right before the disposal, the machine had a remaining net book value of 7,680, which means this was the economic benefit that was still left within the machine for us to use and consume for revenue generation purposes, right? So the machine still had $7,680 worth of value left. And we ended up selling it for $10,000, right? So what does that tell you? We had sold it for more than what it was worth, right? So that means we have made a profit. So the profit on disposal in this case is simply the difference between $10,000, the money that we got by selling the machine, and the value we had for the machine, which was 7,680. So the profit on disposal or the profit on sale of the non-current asset comes out to be $2,320. All right? So I believe you are clear with this. Now, let's move to the second part of the question. All right. So the second part of the question wants us to calculate the total depreciation expense of machinery for the year ended 31 March 2017. All right, so total depreciation expense for machinery for the year ended 31 March 2017. All right, so everything that happened from 1st of April 2016 until 31 March 2017, any new purchases of machine, including the old machine, every depreciation had to be calculated in this case. All right, so first of all, we want to look into the purchase of the new machine. Now, the purchase of the new machine is mentioned in the last line of this first paragraph, which says, on the same day, she bought one new machine for $13,500 from All Star Machines Limited on credit. Now, the purchase of the new machine is very simple. And the depreciation here is calculated by multiplying the percentage with the cost based on the company's policy of applying a full depreciation in the year of purchase. All right. So we are just simply multiplying 20% with the cost of $13,500, and that gives us a depreciation of $2,700 for the new machine. All right. Now, the complication that you may experience is in terms of how much machinery is actually remaining from the old batch that we had initially at 1 April 2016. All right. Now, we want to know the remaining old machinery from the batch that we had at 1 April 2016 after we got rid of the asset or after the disposal of the machine. Okay, so we want to do this by first finding the net book value at the beginning of the year on 1 April 2016. So how do we find the net book value at any given point in time? We take the original cost and we subtract the accumulated depreciation. The original cost is given to us as $20,000, and the accumulated depreciation, as you can see, it's given in the first section of the question, which is $6,820. So 20,000 minus 6,820, which is cost minus accumulated depreciation, gives us the net book value at $13,180 for 1 April 2016, right? So this was all the old machinery that we started the year with. But during the year, we had sold one machinery, and the net book value of that machine, which we had sold, if you recall, was $7,680, okay? So we want to remove this net book value for the machine that we had sold from the total net book value for all machinery that we had at the beginning of the year on 1 April 2016, okay? So $13,180, which is the net book value for all machinery that we had at the beginning of the year, minus the net book value of the machine that we had disposed or sold, which is $7,680. We are left with $5,500 in net book value for the remaining old machinery from 1 April 2016. Makes sense? Now we are following the reducing balance method for this question, right? So what we're going to do in this case is multiply 20% with this net book value to find the depreciation for this old machinery for the year ended 31 March 2017, which is 20% multiplied with 5,500, and that gives us $1,100. Okay? Now the total depreciation expense for the year ended 31 March 2017, which means the financial year that started on 1 April 2016 and ended on 31 March 2017, is $1,100 that we just got for the old remaining machinery, plus $2,700, which is the depreciation for the new purchase of the machine that we had done. And altogether, the total depreciation expense for the year ended 31 March 2017 is $3,800. All good? Okay, so let's move to question C. Name and explain one accounting principle applied when a business provides depreciation. All right, so we will look into two accounting principles that make sense. Now, the first one is the matching theory or the matching concept. And under the matching theory, profit for a business is determined by taking all revenues that we have earned minus all expenses that we have incurred. Okay? Now, when it comes to depreciation expense, what do we understand by that? Depreciation is basically the portion of the cost from the non-current asset, the economic benefit that we had consumed during the year, right? So as the asset gets used up, we consume a portion of the economic benefit for helping us generating the revenue, and as a result of which the depreciation expense is incurred. And this expense is always included as part of the total expenses for profit calculation, for accurate profit calculation. Okay? The next concept we can think of is the prudence concept. Now, when we think of the prudence concept, it is very simple, which says that assets are never to be overstated. Okay? Assets are never to be overstated. Assets and profit are never to be overstated, and expenses and liabilities are not to be understated. Okay? So this is a second one that you can think of. All right. So when we include the depreciation expense that we have incurred from the consumption of the economic benefit for the asset that we have utilized within our business for the purpose of generating revenue, we know that it's going to end up in decreasing the value of the asset that we have in the books, because the net book value is going to decrease when you have a depreciation, right? Because how do we calculate net book value? The difference between the original cost and the accumulated depreciation at any given point in time. So when you have depreciation expense, your net book value is going to go down. And therefore, we want to make sure that that net book value accurately reflects the economic benefit that's available within that specific asset for consumption in the future and help the business generate revenue. So we don't want to overstate our assets in the financial statements, all right? And we don't want to overstate our profits. We want to make sure all the expenses are accurately reflected in the calculation of profit. Okay, so that's the whole purpose behind the prudence concept, which simply states that you should never overstate assets and profits, and you should never understate expenses and liabilities. All right? Okay, now let's move to the last question, which is question D. For each of the transactions below, state if it is a capital expenditure or a revenue expenditure. Now, what do we understand by capital expenditure and revenue expenditure? All right. So capital expenditure is when we purchase a new non-current asset and when we add value to an existing non-current asset, okay? And revenue expenditure relates to the day-to-day operational expenditure of the business, all right? So in other words, revenue expenditure refers to the running costs of your business, all right? So starting with the first one, charge depreciation on leasehold premises. Now, depreciation is an expense, and any expense is classified as a revenue expenditure. All right? Because as we understand, what is the meaning of depreciation? Depreciation expense is incurred when we consume a portion of the cost from our non-current asset. Here, I'm referring to the economic benefit that comes with that non-current asset for the purpose of generating revenue, right? So when we have utilized that economic benefit, that cost is consumed, that economic benefit is consumed, and that is a revenue expenditure, and we call it an expense as well. Next, we have got purchased inventory worth $500. Now, inventory is a current asset, and when you're running a business, you are buying inventory for the purpose of reselling them at a profit, right? You're not buying inventory for other purposes other than selling them for a markup or for a profit to your customers. So this is part of your regular business operations, regular business expenditure, right? So therefore, this is also a revenue expenditure. All right, point number 3, repainting of the shop premises. So repainting of the shop premises relates to maintenance of the shop premises. Like you want to make sure the shop premises looks nice for your customers, all right? And therefore, this is also part of the running costs of the business, and we should also classify this as a revenue expenditure. All right, so lastly, installation of a security system in the office. Now, this is a capital expenditure, and I need you to take 5 seconds and figure out why. 1, 2, 3, 4, 5. Okay, so what do we understand by capital expenditure? Capital expenditure relates to the purchase of non-current assets or adding value to an existing non-current asset. Okay. If you're buying a security system for your office, it is a non-current asset because you're buying it so that you can utilize this system for more than 1 year, and therefore this falls within the definition or category of non-current assets. And this security system could be lots and lots of cameras, including the computer from where you're going to monitor your office. Okay, now office in itself was an existing non-current asset, and then you added extra value on top by including more cameras and, let's say, the computer to monitor those cameras and for investigation purposes. So this refers to adding value to an existing non-current asset, which is the purchase of the security system. And therefore, This is classified as capital expenditure, and also we call this a non-current asset because you're buying this security system for implementation within the business for more than one financial year. All right? Okay. So that's all for today's lesson. If you found value in this content, make sure to like this video and subscribe to this channel, and stay tuned for more videos that I'll upload soon.